Good morning and welcome to Charting the Markets on Friday, the 8th of March 2024. The FTSE 100 has risen in line with other equity markets globally as rate cut expectations are once again at the forefront of investors' minds. And if we look at the FTSE 100 daily financial bet, we can see here that we retested the 7,700 to 7,710 resistance area going back to the beginning of February, as the FTSE 100 benefited from mergers and acquisitions activity, positive results, and also rate cut expectations. And we can see that the FTSE is today coming off slightly, and that is because we've got US non-farm payrolls out at 1:30 p.m. And obviously they might impact rate cut expectations going forward. But coming back to the FTSE 100, we had Virgin Money jump by 35% as the Nationwide Building Society reached a preliminary agreement to take over the bank for £2.9 billion. And we also saw yesterday Rentokil shares jump by 17.5% after the UK-based pest controller reported full-year earnings, which came in better than expected, and also a plan to recover organic growth in the US. Now, we can see that short term, as I said, the FTSE 100 is capped here at 7,715, so just marginally above the 7th of February high. And we'll have to see whether we can remain above this key support area going back to the end of February between 7,598 and 96. And as long as that holds, we basically remain in a sideways trading holding pattern. But if we were to rise later today above 7,715 and on a daily chart closing basis, close above there, also on a weekly chart closing basis, because it's Friday today, we would probably then head back up again towards this resistance area, going back to the resistance line from December of last year at 7,745. And also the February high at 7,750, together with the 7,769 December high represents a really, really important resistance area. But as I said, short term, we're consolidating. And the story is quite similar in Germany, where we did make a new record high yesterday, as you can see here on the DAX 40 contract. And then earlier this morning, went up to 17,909 before consolidating ahead of this very important US non-farm payrolls data. And what we're seeing here is just a consolidation. As long as we stay above not just Thursday's low, but also Tuesday's low at 17,634, the uptrend very much remains intact. And if we were to rise above today's high at 17,909, we could then head towards the psychological 18,000 mark. And if you look at the S&P 500, what we also saw is a new record high being made yesterday after Jerome Powell finished his testimony to Congress. And in his speech, he basically said that inflation rate is cooling in the US, and that he is probably happy to cut rates, hinting at a June rate cut, despite low unemployment in the United States. And unless today's non-farm payrolls data comes in exceptionally strong, it is unlikely to alter those expectations of an upcoming Fed rate cut in June. And we can see here we've got a resistance line going back to the mid-February high, and that would come in around 5,180, which may be hit later on today, depending on the payroll number, obviously. And if payrolls were to disappoint and were to come in much, much stronger than expected, perhaps we could consolidate. But even then, we would have to fall out of this wedge formation and through Tuesday's low at 5,057 for a top to be formed. So unless that happens, further upside is likely in store for the S&P 500, making new record highs. And the story is quite similar with regards to the Nasdaq 100. We can see here that it is also heading back up again towards Monday's all-time record high here on this daily financial bet at 18,342. But for the time being, we are still seeing negative divergence because the current price high hasn't been confirmed by a new reading and a new higher high on the relative strength index. If we were to make a new record high today, and if the oscillate at the bottom of the relative strength index were to also rise above its early March high, then this negative divergence would no longer be in play. And we could, in that case, probably head all the way up towards the 18,500 mark or so. Here, the story is quite similar to that of the S&P 500, in that as long as we stay above Tuesday's low at 17,805, the uptrend is very much intact because we've got a series of higher highs and higher lows. The US dollar has dropped to a near 3 months low on those brought forward rate cut expectations with regards to the likelihood of a June rate cut now being seen in the US this year. And the currencies such as the Australian dollar and euro and the British pound have benefited from this weakening US dollar and have formed bottoming formations, as you can see here on the Australian dollar versus the US dollar. And the fact that the gold price is also trading at all-time record highs and yesterday made a 7th consecutive day of gains, as I'll show you later on, has helped the Australian dollar appreciate versus the US dollar. And you can see here we are on track for a 3rd consecutive day of gains. And more importantly, yesterday we closed above the last reaction high. That is to say, this midpoint here of this corrective phase to the downside, the 22nd of February high at 65.95. And that confirmed that we formed a major bullish reversal pattern here on a medium-term basis. And the fact that today we've risen also above the late January high at 66.24 reconfirms this bullish reversal. What does that mean for the currency pair? Well, it does mean that the decline we've seen from the December high to the February low has probably now ended, and that the longer-term uptrend you can see going back to October of last year has now resumed, meaning that we should soon hit the early December high at 66.88 and head upwards towards the 68.71 high seen at the end of December of last year. The story is similarly bullish with regards to the euro dollar, but before I look at that, I'd like to have a look at the Japanese yen, because what we can see here is the opposite, a very, very sharp decline, taking us back down again towards this red line here, the 200-day simply moving average, and also the early February low between 146 yen and 14 sen and 145 yen and 90 sen. So that's the next downside target area, which may short-term act as support, though. The reason for this decline in the US dollar against the Japanese yen is yen strengthening, as we saw comments from the Bank of Japan out this week, which showed that the Bank of Japan might even hike its rates at its next meeting on the 19th of March, as the private sector wages in Japan have risen, and as therefore inflation is also remaining relatively stubborn in Japan. And as the Bank of Japan wants to move away from its ultra-loose monetary policy with its currently still minus 10 basis point negative rate, and this would mean that we would probably see the first rate hike by probably 10 basis point since 2006, if indeed we were to see a rate hike at the 19th of March meeting. And what is interesting is that on this decline we saw very rapidly over the last 4 consecutive days in this currency pair, we basically also saw rate hike expectations for Japan rise from about 40% or so of market participants expecting a rate hike to now about 75%. So that explains this bearish trend that we're seeing now. And if indeed we were to see rate hikes again in Japan, you would probably expect the US dollar to slide back towards the psychological 140 area where it traded back at the end of December with regards to the Japanese yen. But I also told you about the euro and the US dollar, and you can see here that here we've also formed a bottoming formation by rising and closing above the 22nd of February high, and you can see that we've now resumed the uptrend from the low seen back in October as well, and should be heading towards the late November and early December, mid-December highs between 110.17 and 110.09, and above there we also have the December high at 111.39, which now beckons for this currency pair as well. The weaker US dollar has helped some commodities such as gold and silver rise very rapidly. But let's start off by having a look at the gold at the US crude oil price. You can see here WTI futures trading in a sideways trading range, but trading towards the top of that sideways trading range and having on Friday of last week risen to 80.48 on this front futures contract, a level last traded in early November of last year. We have been consolidating ever since below that high this week and around the red line here, the 200-day simply moving average at 77.96. But you can see here also we've got a tentative uptrend line going back to the 5th of February low. And that together with the 200-day simply moving average today at 77.96 should act as support. And provided we stay above the last reaction low, that's to say a low which is lower than the one to its left and to its right on the daily candlestick chart, that is to say the 5th of March low from this Tuesday, which was made at 77.29, provided we stay above there, the uptrend is still very much intact despite this week's sideways trading range. Now, what I am saying is that if we were to remain above that 77.29 low on the daily chart closing basis next week, we should probably attempt another break to the upside. And if we were to rise above 80.48, the current March high, we could then head back up again towards the psychological $90 mark for the crude oil price with regards to WTI. So here we've also, or I should say we are in the process of forming a saucer bottom, so a long drawn out bottom here with regards to this futures contract. Now, the gold price I mentioned has risen very sharply, as you can see here, over the last few days, as China is buying a lot of gold, apparently, and as investors in general seem to be heading back into buying this precious metal. And you can see here we are now on track for our 8th consecutive day of gains, trading in record highs so far on this daily financial bed, heading up to $2,171 per troy ounce, a new record high, which was made above the December record high of $2,021 per troy ounce. And yes, the upside momentum is slowing down, but the trend, dear friend, and that's still pointing higher. So we are still targeting the psychological $2,200 mark and may actually rise over the next few months much higher towards the $2,400 mark, which is a psychological level and also a Fibonacci extension. So here you can see further upside likely to be seen over the coming days and weeks and perhaps month. And the first support level comes in at the December high, $2,121 per troy ounce. The silver price has also caught on to this bullish momentum. And you can see here that we are now rising again and are heading towards the $24.60 per troy ounce high seen on the 22nd of December of last year. And above there, we also have another target, which is the $25.01 mark at the 30th of August high. So that's the next upside target area, $24.60 to $25.01. And then above there, we also have the December high, $25.77 as potential upside target in our sights. Now here, the uptrend will remain valid as long as we stay above the last reaction low. That's to say Wednesday's low at $23.57. And basically here, again, the fact that we've now risen above this $23.50 to 53 resistance area, the mid-January and also the mid-February highs, means that we formed a bottom formation. Now I've confirmed this bullish reversal out of that bottoming formation into new highs from a technical perspective as well. Thank you very much for watching Charting in the Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle you can see here on the screen. It's at AxelR_IG. Have a lovely weekend.